We're going to do something different. We're going to have a dynamic duo presenters, two hedge fund managers from San Francisco, Carlo Cannell, Cannell Capital, Scott Fearon from Crown Advisors Management. They have about 60 years of experience between the two of them, and in Wall Street we call you guys dinosaurs, just to let you know. Let's see. Oh, Carlo is famous for calling out Jim Cramer from TheStreet.com a few years ago. I don't know if you saw that, activist investor, where he demanded a pay cut, and I have to read this because I can't remember it all, and brilliantly demanded that Cramer no longer have assistants spraying ionized lavender water on his barren cranium. Did you actually say that? Yeah. There you go. All right, welcome Scott and Carlo.
Okay, we are the two Amigos. My name is Carlo Cannell, and this is Scott Fearon, my friend. We're going to talk about dead companies. We're going to give you a few examples, and we're going to try to convince you that it's often foolhardy to buy common stocks. Scott has written a book, which I'm a great fan of. I was the first one to read the Dead Companies Walking, and it's available now on Amazon. Scott, I think you told me you've shorted how many companies have gone to zero?
I've been short 240 plus companies that have filed bankruptcy and gone to zero. And so after doing this for 23 years, I realized I need to write a book about it. And so I did that in conjunction with the UC Berkeley journalism department. And if you buy the book, everything goes to charity. So I almost cringed this morning when I saw all these books for sale, and I thought, hell, my book should be up there. But it's not.
Okay, so I'm going to start off with two examples. We hope that this is interactive. We're going to whip through them pretty quickly, and then you can just fire away. We haven't spent a lot of time with this presentation, as you will shortly realize. Okay, so this is a Pet Airways. This is a Pony Express for dogs. It's an expensive, slow, and stupid airline. It started in 2010 and operated from 9 airports. Here is how it worked. After passing an examination by a veterinarian, a limo came and picked up your dog or cat or turtle and took it to the airport. And all of these animals flew together. It took 24 hours to get from Fort Lauderdale to Denver, and the pets were walked and fed only once. This service cost $800 versus commercial, where depending on your status, usually costs about $200 to fly a pet. We did a Google search of the telephone number, which didn't seem right in the SEC filings, and it rang through to an automobile dealership in San Jose, California. Keep in mind, this is a Fort Lauderdale company, which in and of itself it could be a good reason to short the stock. Anyhow, all investing should be this easy, rewarding, and fun as this particular company. It had a peak market capitalization of over $100 million. There was never any type of metrics in which to value it. So, the company was formed by a husband and wife team, Dan Wiesel and Chief Development Officer Elisa Binder, listed the company via reverse merger in 2010. By April 2012, Pet Airways was done. In March 2014, the company changed its name to Praxin Corporation. Praxin owns a drugstore and sells medical salves. There are 100 million shares outstanding, and they trade at 2 cents a share. Dan Wiesel is still the largest shareholder, owning 78 million shares today. You simply can't make these things up. Okay, example number 2. This is a little more colorful. This is Khalil Tuzman. He was star of the popular 2001 documentary Startup.com. He purchased a controlling stake in Rue Group, anointing himself as chairman and CEO. Rue then became Kit Digital, a video management software and services company, listing on the NASDAQ in August 2009. Kit proceeded to go on an acquisition binge, acquiring 4 companies in 2008, 4 in 2009, 5 in 2010, and 4 in 2011. Kit did 6 equity offerings between 2009 and 2011, raising more than $250 million. Headcount ballooned to over 1,500 employees at its peak, at which time it moved its headquarters from Dubai to Prague. Again, this is a NASDAQ-listed company. Here are some of the brokers sponsoring and promoting Kit Digital. Whilst this is not Goldman Sachs or Morgan Stanley, there are names that have some credibility. And here's a quote from one of these brokers, Darren Afty, who was using a price target of $18 on December 19th, 2011. With shares trading at 5 times our EV to 2012 EBITDA estimate, we believe the stock has the potential for significant appreciation as the company is trading more in line with traditional media comps, roughly 4.4, versus new media comp multiples of roughly 10. Beware the relative valuation. So this guy was a pretty strange dude. When he traveled, he brought his dog with him in first class. He allegedly would require equity salesmen to walk his dog during investor meetings. This is not sufficient to short the stock, but it's certainly it's a nice to have. In 2011, he was allegedly arrested in Dubai for getting into a fight with his own lawyer. According to the complaint, Mr. Tusman had insulted the honor of the plaintiff. There's the stock chart. In March of 2012, Kit disclosed a delay in filing their 10K to allow auditors more time to look in the treatment of intangibles. Now, this is triggered by something called a Form NT, which, Scott, I'm sure you're familiar with. This is a filing that says there may be a problem. Right? Microsoft does not file Form NTs. So, if you want to run an interesting screen, run a screen for this kind of esoteric Form NT. On November 12, 2012, the company announced that they would need to restate financials, not just for the prior period, but for all of 2009, 2010, 2011, and the first half of 2012. Basically, the entire existence of the company's history. Furthermore, the company would be changing auditors, delisting from NASDAQ, and was in default of a loan. Here are some of the significant institutional shareholders of the company. General George S. Patton said, "If everybody is thinking alike, somebody is not thinking." The game came to an end when Kit Digital filed for bankruptcy protection in April 2013. On September 7th, Mr. Tusman and the CFO, Robin Smith, were arrested. It is my experience that a divergence between cash flow and net income is often, but not always, a tell. They should be congruent, or they should be trending towards congruency. And I'm sure Scott will speak to this as well, but we see again and again where companies are seeming to report very good news, but then we go back, where's the cash? Earnings going up, cash is leaving the company. Never a good sign unless you are satanic short sellers like us. Yeah. Okay, so where's Mr. Tusman now? Mr. Tusman recently sent out an invitation to the 7th annual Columbia celebration, sponsored by Kit Capital, to be held in drug cartel favorite Medellin, Colombia, starting November 18th, 2015. Jameson, this might be an appropriate venue for next year. This 10-day event will straddle local Independence Day celebrations, island trips, world-class parties, and the coronation of Miss Columbia. We hope you will think of Kit Capital as your Columbia connection, wrote Mr. Tusman. Sadly, Mr. Tusman will be unable to make the fiesta. He was arrested September 7th and currently resides in a Colombian prison. So those are my two examples.
Wow.
We're going to shift into.
Well, that will be hard to top. Let me just start by saying it's an honor to be here. I've always been a huge fan of Dr. Ron Paul, so got to meet him this morning. And I want to thank Stansberry and Carlo who dragged me here from the Bay Area. And let me just start by, hey, we're here trying to entertain you guys, but also there's a message, which is that an awful lot of publicly traded companies do fail. I've been to visit literally 1,800 company headquarters over the 23 years I've run my hedge fund. And believe it or not, over half of them today have stock prices below where they were the day I walked out of the company headquarters. So the indexes are market cap weighted events, and a few behemoth winners like Nike or Apple, they can make an index go up while hundreds of little companies that are in that same index can go down or even go to zero. So and for a little levity, here's a joke, because that's all we do in the Bay Area is get together for dinner and tell jokes. So a guy's been a money manager for 20 years. He's done well, but he's fed up with the business, tired of trying to outguess the Fed, and he decides, heck, I'm going to move up to Alaska. I'm going to live by myself, hunt and fish, and try to enjoy it a couple of years of my life. So the guy goes up there, and the very first week he's in Alaska, there's a knock at the door. And he opens the door, and there's this old grizzled guy, and he goes, "Howdy, neighbor, welcome to Alaska." The guy goes, "Whoa." He goes, "Who are you?" He goes, "I'm your neighbor. I'm 3 miles down the road, nearest house. You can't see me, but I've been here for about 15 years. The guy goes, "Well, hey, that's great." He goes, "Well, just want you to know, something we do here in Alaska is we like to have a party for the new residents. And I'm having a party this Friday night at my house for you." The guy goes, "Hey, that's great." He goes, "What happens at an Alaskan party?" He goes, "Well, there's going to be some dancing because we're mighty social here in Alaska. And there's going to be some drinking because we're up here in the wild. And, we're kind of ornery at times, so there might be some fighting. And I bet you by the end of the night, there might be some screwing." The guy goes, "Oh my God, that sounds great. What do I wear?" The guy goes, "You can wear whatever you want. It's just you and me." That's the joke. Somebody, raise your hand if you've heard that joke. Somebody, okay.
Oh, no.
Okay, damn. Okay, I'm going to talk about, my slides didn't happen, that's my fault. So I'm going to talk about two companies that I visited that I shorted that subsequently went bankrupt. And the first one will be a company called, Vivas, which is an inch away from bankruptcy. And the other one is Blockbuster, which we all know, which did file bankruptcy 3 years ago. A couple things about shorting stocks. A famous money manager in New York City, a guy by the name of David Rocker, once said, there are three types of companies that go under. There are frauds, there are fads, and there are failures. And the vast majority of bankruptcies tend to be the latter. They're just companies that peter out and go broke. Just this year, just in the last 2 months, in the apparel space, American Apparel filed bankruptcy. That's a Los Angeles apparel company. Wet Seal, another apparel company, filed bankruptcy. There have been, if you go back over the last 5 to 10 years, there have been an awful lot of bankruptcies across a lot of different spaces. Apparel is very common. Bankruptcies have been on and on and on. And so my focus has always been on trying to identify companies that I just think would fail. I'm not necessarily trying to find a fad like hula hoops or inline skates or frauds like Enron. While they're exciting as heck to try to find, it's very hard to uncover a fraud, short the stock, get your timing right, and make a lot of money. So the first company I'd like to talk about is Vivas. Now, anybody in this room heard the name Vivas, the publicly traded company? Nobody. Okay.
A few.
So Vivas is a company that today sells for $1.50 a share. It has yet to file bankruptcy, actually. The market cap is $200 million. This is a company that in the year 1996, ticker symbols VVUS, received approval for the first erectile dysfunction drug in the United States. This was Viagra before there was Viagra. But what was so weird about this company, which is to this day still based in Mountain View, California, was the delivery mechanism for which this drug worked. And I will have to read it to you because I can't make this stuff up. Delivery for the Vivas product, which is used for erectile dysfunction, is, quote, a suppository which, when inserted into the male urethra shortly before sex, improved blood flow to the penis, thus alleviating the symptoms of erectile dysfunction. Now, I was physically in the company's headquarters, swear to God, physically in the company's headquarters in Mountain View, California, in the middle of 1997. The drug had been approved, and believe it or not, the first 12-month revenues for this product, which you could buy with a prescription, roughly $10, the first 12-month revenues were $130 million. The stock had gone from single digits to $40 a share. Unfortunately for the company, the day I was physically in the offices meeting with the chief financial officer, another company called Pfizer had just received approval for a product called Viagra. So the stock's $40 a share. I'm in the office with the CFO, and I said, whoa. I said, this has got to be a risk. This product, this Viagra, is apparently a pill. You just swallow it, and boom, it does the same thing that your delightful device does. And the chief financial officer looked me in the eye, and he said, yeah, it's a good thing that Viagra was approved. We think it validates the space, and we think the two of us will split revenues 50-50 in the next 5 to 15 years. And I looked at him, and I said, really? Like, let me get this straight. Again, your product, you have to literally insert a small tablet into your penis to get this product, your product to work, and there's a pill. He goes, yeah, but he goes, not everybody's going to want to take a pill.
Yeah.
So it's really happened, guys. And so amazingly, I shorted the stock, and the history is now shown. The Viagra today is a billion-dollar revenue drug for Pfizer, and there are other products on the market too. The Vivas product, which was called Muse, that product was finally sold. The rights to the drug were sold to a Swedish company for $22 million in the year 2010. Revenues for the Vivas product today, it's now owned by this Swedish private entity, are under $20 million a year. So I think the lesson learned from that experience when I was in their office is that just because a guy's a CFO or a CEO doesn't mean he has vision on how the world might change. And senior managements, even if they're honest engines, well-educated, famous schools, they can make mistakes. And this guy, I think he more wanted to believe what he was telling me than he honestly believed what he was telling me. To this day, and what's maybe even more interesting is that this company, the stock went from 40 all the way down to 1 and change, and then they started development on yet another dream drug, which is one of these pills for being overweight. And their drug was approved a couple of years ago. The stock literally ran back into the teens, and then as you guys may know, all 3 of the pills that were approved by the FDA for being obese have been severe disappointments at the revenue line. Other companies that do this are Orexogen and Arena Pharmaceutical, and all 3 of these stocks have now gone back to low single digits. Vivas hasn't gone broke yet, but it's a $1.50 stock. And somebody once told me, he said, here's the thing about investing in drug companies or biotech companies. It's that they're really an awful lot like a love affair. They go up on the excitement and the hype, and they die on the numbers. And that stock died on the numbers. My second company, you jump right in, my man.
Before the second one. So, first of all, we don't want to leave you with the impression that all we do is sell stocks.
Right.
I mean, we buy a lot of things. We buy things on the other end of the spectrum, more deep value, and then we use these. What's supposed to happen is the Vivases go to zero, and then our dull snowplow companies or what have you, they increase in value as they should. Right? And that's what a true hedge fund should do, different ends of the equity spectrum. But there's another theme here which hopefully is being articulated, and that is it's funny. Short selling is fun. If you buy a savings and loan institution, it's like watching paint dry. And I've done well in some savings and loans, and hopefully will continue to do so, but it's not fun. I mean, you visit the company, and you have to hit the CEO with a stick to see whether he's still breathing, and, it's okay. But the theme here with the short selling is this book is filled with funny stuff, and our job is funny, right?
Yeah. I mean, it's fun too. I mean, as I said, I've been to visit 1,800 companies, and I've seen it all. I put about 50 of the stories in the book, and it all goes to charity if you buy it. But yeah, it's fun. I mean, but again, the message I think is this is a very important message to this crowd, which is that most smaller, obscure, manana story stocks, they're going to go to zero. It might take 5 years, it might take 15, but very rarely will you or I ever find a $1 or $2 stock with no revenues that's going to become a monster winner. It just doesn't happen. And sadly on Wall Street there are some promoter types that want to bring garbage public.
Every restaurant will go out of business if you live long enough.
There's some truth to that.
Every retailer will go out of business if you live long enough.
It's true.
It's just the mortality rate, the power of gravity. Business is tough.
Business is very tough. Retail is, for me, I've been short over 20 retailers who have gone bankrupt. I love to read this because you guys probably used to shop at these stores. Bombay, Circuit City, remember Discovery Zone, Wilson Leathers, Ultimate Electronics, 50 Off Stores, Garden Botanica. Video rental industry, which I'm now going to talk about, they all went broke. Remember? Movie Gallery, Hollywood Entertainment, Video Update, and my favorite, Blockbuster. So,
and these were high flyers, too. These weren't like, the pet company, the pet airline.
Weren't some,
These were big.
It wasn't Kit Digital. It was some guy with a dog on his lap. I mean,
yeah.
Those are hard to find. Those are precious if you can find them. So, I mean, I guess, before I give you my 3 minutes on Blockbuster, I think the message to you guys is that, hey, be careful when you invest. Be careful buying story stocks, speculative stocks. While the indexes over, the history of the U.S. have given you a pretty good return, underneath these indexes, there's a ton of companies that fail. A ton of companies.
So my view of that is a little different. So when I think about the index, what is an index? To get into the S&P 500, you have to have gone to Yale, and you've had to go to Harvard Business School, and then you've had to, been pruned and perfumed, and then a lot of luck, and then you're in the S&P 500. But what about, the thug who's a drug dealer who's like never even going to anywhere get near to Yale, right? So there's a counter, there's an antimatter out there, and that's the Wilshire 7,000. It's the companies that never, ever, or God knows how they got public. And if you were to adjust and make an index of those companies, it would be shocking. Because what happens with the S&P 500 is that when there's a little bit of rot, just get rid of it. And then bring in another one. And that's not really the way the world works.
Blockbuster. So, as I said, I've visited almost 1,800 company headquarters over the last 24 years of running my hedge fund. Only $100 million, by the way. I'm not some famous New York hedge fund manager. I was physically in Blockbuster's corporate headquarters in late 2007. And at the time, the stock was about $5.50 a share. And the history of Blockbuster is, I think, instructive one. It one time was a behemoth company, and at the end was not just did it file bankruptcy, they've liquidated every single store. They don't exist anymore. The history was pretty quick. The first store opened in Dallas in 1985. That's where the company was always headquartered. And in 1994, and 2 years after that, a very famous guy named Wayne Huizenga bought the company for a very small amount of money. He owned it from 87 to 94, at which point Wayne Huizenga sold to Viacom for $8.4 billion. So that should kind of tell you why Wayne Huizenga was able to buy the Miami Dolphins and other fun things like that. But as this was going on, as they were growing, very quietly in the late 90s, a company in San Jose called Netflix started up. Very quietly. And in fact, the story goes, Netflix started because the current CEO of Netflix, a guy by the name of Reed Hastings, he's on CNBC all the time, supposedly he had rented the movie Apollo 13, and he went to the Blockbuster store, and he had a $35 late fee, and he was so pissed. He said, the hell with it. I'm going to start a company where I'm going to mail you DVDs in the mail. The hell with this Blockbuster late fee stuff. And I used to pay, I think I had the biggest late fees in history in my town in Marin County because my kids would rent them and forget they rented them. And 2 months later, I'm begging for a discount on the late fee. So anyway, Blockbuster came public in 1999, the IPO, and by 2000, something really weird happened. Netflix went to Blockbuster's corporate office and tried to sell Netflix to Blockbuster for $50 million. And this is public. This event occurred, and the people at Blockbuster said, "Get out of here. Sending movies in the mail, today, Netflix has a market capitalization of over $65 billion. So that was a mistake by management at Blockbuster. So we move forward. So both companies are now, Blockbuster has always had its store base. At the peak, there were 9,000 Blockbuster stores. At the peak, Blockbuster was doing $6 billion a year in revenues. At the peak, Blockbuster was a profitable company. But Netflix was growing their model quickly. In 2006, Netflix had 6 million subscribers. Today, Netflix has, I think, 66 million subscribers. And the way most people subscribe to Netflix is on this a digital delivery model. You can still get those DVDs in the mail, by the way. Anyway, in 2008, 2 months after I was physically in their offices, the CEO of Blockbuster, stock was they were starting to lose money every quarter. They'd had 3 quarterly losses, and they had this cockamamie idea that, hey, we're going to move from rental to retail. When I was in their offices in late 2007, that's all they wanted to talk to me about, how, hey, Netflix can do this mail order crap and devise a digital delivery model. We're going to sell movies, kids' movies. We're going to sell popcorn. We're going to sell candy. It's going to be like going to the movie theater when you go to a Blockbuster store. And that's going to be as big, if not bigger, than this digital delivery stuff. And they really believed it. And at the time, they'd already gotten up to about $900 billion of debt. And the CEO at the time had this incredible quote, the CEO of Blockbuster. He said, quote, "I've been frankly confused by this fascination that everybody has with Netflix. Netflix doesn't really have or do anything that we can't or don't already do ourselves here at Blockbuster." So he was in complete denial that this industry was changing and changing rapidly. So we move forward, the losses mounted, Blockbuster started closing stores, and by 2010, Blockbuster filed bankruptcy. The stock went to zero. And what's even more interesting is that, as I said, every single video rental store went bankrupt. And the moral of that, I think, is you never try to catch a falling knife, or you never average down on cost, right? You've heard the old line, double up, triple up, belly up. When a company's in trouble and the stock is plummeting, usually on poor quarterly earnings announcements, meaning profits have become losses, you as an investor should never buy more. And yet, that's an instinct some of us, myself included, we sometimes all share, which is that desire to, damn it, I bought Blockbuster at 10 and I really liked the management because I saw him make a presentation somewhere, stock's at 5, I'm going to buy more. But the bottom line is companies and entire industries go out of business. I mean, years ago was at all the paging manufacturers. Anybody here have a pager attached to their belt? They don't.
Yeah, once the rigor mortis sets in, it's really hard to revive the patient. Sure. The arm is cut off, and it's just the blood is coming out. It's morbid, but these companies don't come back.
They don't come back. I mean, for me, I wrote down here, I was sitting in the back row listening to everybody, I wrote, the 3 lessons I take away. First and foremost, if you're going to try to stock pick, if you're going to buy individual stocks, you really need to be strict about this one. Only buy the stocks of currently profitable companies. I'm not a venture capitalist. I don't get to go on the board. I don't get to handpick the CEO, and you guys aren't either. So if you're buying individual stocks, it better be profitable, and even better yet, hopefully it pays a quarterly dividend. Otherwise, you're going to be disappointed time and time again when you buy what we call mañana stocks, story stocks that aren't profitable, may not even have revenues. It's a tough way to make money. I think number 2 is avoid low-price stocks. If a stock's under $5 a share, it's usually there for a reason, which is something went really wrong in the last year or 2 or 3. Bad management, bad product, bad balance sheet, all 3. Be very, you want to own stocks that are 150, 250 price line. You want to own the behemoths that have had great earnings, great quarterly growth, and the stock validates that. Be careful about buying these low single-digit stocks. And as I earlier said, don't never average down on your cost. If you own it at 10, don't buy more at 5. The old joke is that averaging down on cost has killed more people than Hitler. You don't do it, ever. And if you just adhere to those 3 little rules, I think you'll be a better stock picker. So
we got some time for questions. We're hopeful. I don't think there have been any questions earlier in the session, but I've got a mic here. Or maybe no questions. I can barely see out in the.
You can't see up here. It's hotter than hell up here too.
Here's a.
How do you evaluate a PE on the stock? At what point would you say, hey, the stock's too high priced? When the PE, when you're looking at the price earnings?
Well, I don't think valuation really matters that much. The question was, I believe the question was, do we look at PE? Do we factor that into our selection of the short candidate? My response is, it doesn't really matter what the PE is, because if you have to use my analogy before of a oncology patient, shorting stocks that are just because they're expensive is not a strategy that I deploy. Like Coca-Cola is arguably not a cheap company, right? Salesforce.com is arguably not a cheap company, and so forth.
Chipotle's not a cheap company.
Chipotle is not a cheap
you
company,
wouldn't
but
dare
you know
short
what?
it.
They're really good companies, and I would rather short a company with a low multiple, with the arm off, limping in.
Oh, there's a lot of truth to this.
You're not going to lose. It might be a $3 stock, and one of the reasons I gave the example of this ridiculous airline is only 100 million market cap, but it was very clear. How could anyone assign $1 million to it? I mean, it's just so completely bogus and easy. So you look for the absolute rot and bogosity, if that's a word.
I think a lot of it's got to be. There's a lot of truth to that. I mean, an industry that completely disappeared there were publicly traded payphone companies 15 years ago. I kid you not. Like, you walk up and you put your coin in.
I was short one of them.
And there were 3 of them, and they were 3 times cash flow, 4 times cash flow. But guess what? They all went broke. I mean, they just disappeared because cell phones took over, and you can't find a payphone these days. So I think shorting valuation is very, very difficult strategy. It's something I don't do. I mean, I don't know. Should a stock be 20 times forward earnings, 40 times, 60 times, 80 times? I don't like shorting great companies. I mean, Kramer, for all of his bravado, he has a lot of good, I think, lessons. And one of them is, hey, you want to own best of breed. I would counter that by saying you want to be short worst of breed. That means you're going to be short a lot of stocks that have low valuations, but they're headed towards, restaurants are a great example. Shoney's, who the hell goes to Shoney's? I bet you the stock sells at like 8 times earnings, but it's going to just be a question of time when there is no more Shoney's. And Chipotle's at like 40, I don't know what Chipotle's multiple is, but I've been there twice in the last year. I would never short that management team or that company.
Thank you for the insights. And if I could ask a question that's a little bit on the opposite side. Nobody bats 1,000 in our business, obviously. So what kind of situations have you seen where you've shorted, you thought you had everything right? We know this isn't an easy thing to do, and you've turned out to be wrong. And what are typically the reasons when a company does bounce back when you think it won't?
Well, I never make any mistakes, so I'll let Scott.
That's, you learn from your mistakes, not what you do well, right? Oh, man, have I ever been short something that just kept going? I have a simple rule, 25% wrong and gone. So I start getting out of a position. Yeah, that's a tough one. I mean, the fact that I can't answer that tells you that maybe I'm a shallow person, because I've had a lot of mistakes. Usually it's companies with too much debt. Dex Media I love that because it finally went out last week. But boy, that took 5 more years than I would have thought. That was the last publicly traded Yellow Pages company. I'm going to talk to you later. I do have a list in my bag, I'll tell you. I just can't offhand think of them. That's why I have that rule, though, 25% wrong and gone. Once I'm falling behind versus my cost basis, I start to exit the position. That's smart emotionally and psychologically, because there's nothing worse than looking at a stock you're underwater in. And secondly, it's good for tax reasons, right? You want to incur the tax event now for this year and not, what is it Peter Lynch used to always say? most everyday investors run around watering their weeds and cutting their flowers. Right? You want to let your winners run, and you want to get out of your losers. And I'm gonna find some for you.
I know this doesn't address your question specifically, and I think I avoided it, but there is a tax advantage of short selling. So if you buy dull stuff like I do, like snowplow companies and savings and loans and whatever, oil equipment companies, my favorite holding period is forever, because I do not like to pay taxes. When you short a stock, like the 285 that Scott have shorted that have gone to zero, in many cases they actually don't hit that x-axis. They just become these dead company, walking companies that are 2 or 3 cents. Right. And so if you don't close out the position, you don't realize the loss. Right. And I know it's a little esoteric, and I'm not in a position to render any tax advice, but if you call up the IRS and say, hey, I shorted this company at 100 and now it's at zero, they'll say, send us half of it. But if you say I'm still holding out, for that $100 stock and it's at 2 cents, it's an unrealized gain. And so from a tax perspective, it can be extraordinarily attractive for in our case, to the limited partners.
Yeah, you want to defer the tax event, but that may not a good answer.
Unless you enjoy paying the taxes and you call up the IRS and like, hey, what do I do?
No, let me pay you more. Yeah. Let me move to California and pay all my money in taxes. Yeah.
I had first of all, thanks for insinuating that it's fun. I think it looks like fun to be right about shorting a stock. And in terms of current time, are there specific, not stocks, but industries that you see that are really a dying breed, that you see they're just not going to be around, and make it fun?
Well, I think they're perpetual characteristics. We're like pattern recognition people, sort of, financial radiologists, if you will. And there's certain industries that I think have a higher incidence of mortality than others, right? And the inverse as well. So I think restaurants, as I mentioned earlier, are perpetually challenged. I think airlines are perpetually challenged. I think that hardware, high technology hardware companies are perpetually challenged. It doesn't mean that there can't be dramatic successes within those sectors, but I think the wind is always in front of you. I don't think there's any particular industries now that I would say, oh, this is something that you have to run toward.
Well, I'll give you, I'm not short in either group, but there's something very wrong with the cable industry right now.
With what?
The cable industry.
Yeah.
Because my son's 24, he lives in Brooklyn. I'll never forget this. I'm with him a few months ago. He's watching Monday Night Football on his big laptop, and the ads were in German. And I said, Michael, how the heck do you do this? He goes, oh, we all do this. Nobody's paying for cable. We're all cutting the cord out here. My son will never pay for a cable bill in his life. And, we're not that far away where people will watch the shows they want to watch, when they want to watch them, and pay for them directly. If the NFL could ever figure a way to go straight to all of us, oh my God. Now, you haven't heard that yet. The technology's not that far away. Cable industry could have a brutal awakening.
And the broadcasters that are feeding into that, I would add. For example,
you're not gonna,
you have original content coming out of Netflix, coming out of Amazon, coming out of whatever.
Yahoo says they're going to make a comedy show. Alibaba says they're going to make content.
Yeah.
It's pretty crazy. And I'll give you another one. The internet is slowly but surely eating into the everyday apparel retailers. Nobody has quantified this well enough. But I wouldn't want to be JCPenney's or Sears or just kind of a regular, boring mass merchant retailer. Because every year, a growing percent of nationwide retail revenues are happening online. Okay? The Alibaba model is a great model. Amazon, what can we say? Again, complicated situations, not a stock I'd ever want to be short. But the boring, mundane, pedestrian retailers that sell generic this and that, a growing percent of the next generation is going to order that stuff online. I'm more intrigued with Amazon with their drone strategy of delivering, toothpaste and, jockey underwear than walking you or getting into our car and driving to the mall and going to the JCPenney's and trying to park. And hey, the next generation ain't going to be doing that. So those are two.
But we're cognizant of these very popular themes that pop up once in a while. Like I was short all of these biofuel horseshit companies, Solazyme, Amyris. It was unbelievable how much cash they were burning. And then they fade, whatever. And then there's some other, we don't know what'll come up next. I remember years ago, I've been doing this so long, there were these cigar companies that came public. That didn't last very long, So
Well, there have been, those are fads. Pods came public about 15 years ago. This is a little game the kids would play. It's gone. I had somebody tell me on inline skates that, inline skates are going to replace bike riding. Yeah. 15 years from now, nobody's going to own a bike. Everybody's going to be doing those inline skates.
Yeah, Heelys.
Well, Heelys was liquidated, yeah.
Yeah.
But entire industry's in trouble right now. Well, they're out there.
It's fun. We're blessed to be in this business because it's just like laughing all the time and looking at these companies. And it's like, you got to be kidding. It is a little awkward when we visit the companies. I don't visit the shorts as much as Scott does because I'm just like, part of me, I feel badly sometimes, I'm in there and it's like, you don't even know that you don't know. Yeah.
They don't want us here anymore.
We got one
short question.
Sure.
Yes, something quick. Our age group has the history behind us. Should we at some point bring up half a dozen 16-year-old and tell us what the future's going to be?
You know what? Yes, and ICR is a once-a-year conference for the apparel industry. It used to always be down in Laguna Beach at either the St. Regis or the Ritz-Carlton. I don't know if you know Laguna and Aguel area. We live in the Bay Area. I'm in Texas a lot too. But ICR is now in Orlando. They have a lunch session. They bring in 20 high school kids. They give you box lunches, and the moderator asks for an hour and a half kids questions about their life. It's the most fascinating thing in the world.
But counteracting that is teenagers are extremely fickle. My dad is 89 years old, and he's like, does the exact same thing every day, eats the exact same food, right? And you can form companies around that, right? He likes the small little Haagen-Dazs ice cream things that he buys, and he eats two of them every day. And he's going to die eating one of these things. When you sell to my daughter is 18 years old, she can change her appetite for apparel or food or whatever it may be in 6 weeks. It's like nobody does that, which plays into what we do, right? I would rather own a beer distributor in Las Vegas, dull as that may be. They're not going to sell that many more gallons of beer this year than they did last year, but nobody competes with them. And if I have the Bud dealership in Las Vegas, I have to be really smart and dedicated to screw that up, right?
That's true.
Whereas you have some, I don't even know these apparel companies. There's Tilly's or Tooley's.
Oh, Wets. They're all going bankrupt. Wets.
Yeah.
I was at BB's the other day. They're going to go bankrupt. Stock's below $1 now.
So you buy, and if any of you, I know lots of you are entrepreneurs and you own your own businesses, stay within that sector. Harvest that cash. And if you want to get really fancy, then, put on a short sale or hire, weirdos like us to do it for you. But the businesses that are dull and generate cash are wonderful businesses. Everybody that is in a family-run business that is seemingly dull but throws off a lot of cash says, but if I was only involved in that semiconductor capital equipment business, then my life would be so much better.
Yeah,
and that's
software. Yeah.
Or software, or whatever it is. So I don't know. I think we've probably sufficiently.
Oh yeah, I'm right behind you.
Driven a gloom into this conference. And we'll get off the stage now, but thank you.
Thanks. Thanks.